Welcome to Aha Math and Science. Well, before I start this video, first I just want to thank everyone who has been watching this channel, and your support really kind of means a lot. Gives me really the motivation to kind of continue make more videos and share my analysis about the market and other things with you. So if you have not subscribed to our channel, please just take a moment to click the subscribe button, and so that you will not miss the latest analysis that I'll be doing and about the market and other things. So in today's video, I'd like to talk about how close we are to the upcoming recession, and we're going to look at several indicators, and we point out that we could be already in recession or maybe very close to it. The first one we're going to look at is this so-called the net percentage of domestic banks tightening lending standards for basically commercial and industry loans to larger and middle market firms. So this is showing this blue curve, and the other one is similar, which is just loans made to small firms. And you can see that for every recession with kind of this gray area, you can see that this percentage of lending standards get tightened always kind of spikes. In fact, if you look closely, every time since 1990, whenever this percentage of lending standards get tightened, how many banks basically are tightening the lending standards, that percentage. Once it's above 40%, you can see there's always a recession. So let's just draw that line. You can see that very clearly. In fact, once this a percentage is above 40%, it does not take too long. It's going to be just a couple months, or even in some cases already in recession. In this case, it's already in recession once it's close above 40%. Same thing here. That's during the pandemic. Now, just kind of in February of 2023, this percentage crossed above the 40% threshold. So just based on this data alone, we will suspect that it's very likely that we'll be in a recession very soon, or maybe we are already in recession. So this is the data, the latest data for February 2023. Now, before actually the collapse of Silicon Valley Bank and the ongoing banking crisis, also Credit Suisse and First Republic Bank, etc. So the latest news yesterday, it says U.S. bank ranking slumps by most on record in final weeks of March. It kind of continues. The loans made by commercial banks declined by nearly $105 billion. So that's basically very recent after the sort of the banking crisis. We suspect this percentage, the percentage of banks that are tightening their lending standards, is probably a lot higher, maybe 60%. We don't know the exact number, but we suspect this is climbing and it's getting even higher. So this does not look good, because once the banking kind of the loans are made to the firms are kind of decreasing, then it's going to be basically kind of drain the credits for all the firms, and therefore the business are going to kind of slow down. So the next indicator we're going to look at is the ISM Manufacturing Purchase Managers Index, or the PMI Composite Index. You can see in this index, when it's above 50%, above 50, and that means like manufacturing firms are expanding the business. If it's below 50, that's contraction. So what's the current level? The current level, which is this line here, 46.3, that just released a few days ago. This is the data for March 2023. And then we notice that every time, if this PMI, the manufacturing PMI index, starting from a high level, say like above 55, and then it just goes down, and it drops, for example, around like 45. Here it drops, and then just very kind of quickly, the economy is going to enter a recession. This in this case is just 2 months. Here, once it's kind of already dropped below 45, it's already in recession. Here, this is during the pandemic. It drops below 45, it's in recession. So now we are kind of like around this level, right? So it's already a very clear kind of indicator. We may be already in recession based on these three scenarios, or we could be entering recession in like a couple months, like if it's something like the 2000 recession. So this does not bode well. And in fact, we point out that as soon as kind of it cross over this current level 46.3, the PMI index, the manufacturing PMI index, usually kind of have a very sharp drop, which means that the PMI index, which means that the contraction is just kind of accelerate for the manufacturing business. So this is true here, a very sharp drop, a very sharp drop, and very sharp drop, and then we expect something like this will happen just based on history. So obviously this is going to put a really kind of like huge slowdown on the economy, and it will not be a good thing for the stock market, because right now I think that the broad index has not really kind of priced in a scenario like this yet. So this is the second indicator. Again, it kind of pointing to a very likely scenario, which is we are already either in recession or maybe we're very close to it just in a couple months. Let's look at the third indicator. That's also important one. This is called unemployment rate, which everybody kind of watches. So this number kind of spiked to 14.7%, the unemployment rate during the pandemic, and then it has been kind of dropping ever since, and it actually reached a low of 3.4% in January of 2023, and then it just kind of climbed up to 3.6. That's for February, and then just this Friday, the data released. That's the data for March 2023, and the unemployment rate just kind of dipped it down to 3.5%, just a little bit. We point out this indicator is kind of a lagging indicator for the unemployment rate. It's not as actually as kind of timely as the PMI index or the banking, the lending by the banks, so the amount of loans. So, but still can get some information, because if you take a look at the 13 recession since 1940, so there are a total of 13 recessions. Every time when you have a recession, the unemployment rate first has to bottom, and then the unemployment rate starts to go up. So for example, if it bottoms at here, that's for the 1980 recession, and the unemployment rate climbs up. So you need to see the unemployment rate bottoms first. And then once the unemployment rate kind of bottoms, you will see that maybe in a couple months, the unemployment rate starts to increase, and then you have a recession. There's no exception. So this is like 12 recession here. Then the one in 1945 recession is here in this chart. So for example, for the 1990-1991 recession, the unemployment rate bottoms at 5.0%, and then the recession starts when the unemployment rate is at 5.5%. And here, you have here the delay is a little bit large. Basically, the time it takes for the unemployment rate bottoms to when the actual recession, that's the delay we are interested. This is like almost several months. This is almost 2 to 3 months. This is almost like instantaneous. So we can actually analyze the data and plotting the delay from the lowest unemployment rate to when the recession starts. Like how long is the delay? If I already see the unemployment rate bottoms, when does the recession start? Look at this delay and versus what is actually the lowest unemployment rate before the recession. And if we plot this data, this correlation on the chart here, you can see that the vertical axis is the delay from the lowest unemployment rate to the start recession measured in months. The horizontal axis is the lowest unemployment rate before the recession starts in percent. So it varies a lot, but on average, if you look at this delay, once you spot the unemployment rate bottoms to the recession starts, is about 7.8 months. So it varies from 1 to 16 months. But now we have a crucial information, because from both the manufacturing PMI and also the bank lending, we know the recession is really kind of around the corner. So so it's very likely the unemployment rate that we saw in January 2023 could be the lowest one before the current recession starts. So that puts our data kind of on this vertical line. So we know the lowest unemployment rate is somewhere here. So now what's the delay from the lowest unemployment rate to the recession starts? So there are two groups of data. One says this 3 data point says it may take a year also, but there also this data point says it will only just take a 2 to 5 months for the recession to start once you see the unemployment rate bottoms. We suspect now that the unemployment rate is probably around the lowest unemployment rate before the current recession is somewhere around here. And then also the recession is really around the corner based on PMI index and then the bank lending. So this will be our best guess, which basically says it will only take 2 months for the recession to start since January 2023, which is the lowest unemployment rate. So that's our kind of lower bound, which is like, oh, we may be already in recession in March 2023. And maybe it could be like 4 months later. So that will put something around like April and then May when the recession actually starts. So this is really kind of our best guess for based on the unemployment rate information. But in any case, from this analysis, we argue that recession is really around the corner. We are either already in recession or maybe recession is going to start very soon in a couple months. And this, which we certainly has really kind of broad implications for the stock market. And it's something that we really are watching closely. So again, back into kind of the percentage of the banks tightening lending standards. This data is really kind of like crucial and it very clearly shows that whenever it's above 40%, a recession around the corner. So, and then we look at also the manufacturing PMI, we look at the unemployment rate. These multiple indicators all kind of say the same thing, which is recession is around the corner. Either we are already in or we are very close to it. So I hope you have enjoyed this video and found the information presented here interesting. Again, thanks a lot for your support. So that give me the motivation to make videos like this one. And the market is really kind of evolving rapidly. So please make sure to subscribe to our channel so that you can get the latest update analysis of the market. And thank you for watching.